The biggest mistake in real estate isn't buying the wrong property, it's staying at the party too long. For the last 36 months, residential indices have defied logic, but the data is whispering a new truth. Prices aren't just stabilizing, they are hitting a structural ceiling. Today, we are deconstructing the real estate exit strategy, the data-driven blueprint for when to cash out and when to hold, as the market undergoes its most significant classification shift in a generation.
Look at the core central region versus the rest of central region. While headline prices show a marginal 0.5% growth, transaction volumes in major residential hubs have dipped by 12% quarter-on-quarter. We are seeing a price-volume divergence. This is the classic precursor to a trend reversal. In hubs like the RCR, the gap between seller expectations and buyer valuations is wider than it has been since 2018.
Now, let's look at the liquidity heat map. Notice the deep purple zones. These are areas where premium flats are still moving at record PSF. Why? Because liquidity follows quality in a tightening market. However, look at the cooling orange zones in the OCR. The secondary market here is stalling. If your property is in a high supply pipeline zone, your exit window is narrowing faster than you realize.
It's a paradox. Total volume is down, yet million-dollar resale headlines are up. This creates a dangerous illusion of safety for the average homeowner. These premium transactions are outliers, driven by specific demographics, mainly right-sizers with deep cash reserves. For the standard 3-bedroom unit, the reality is a growing inventory of unsold listings that have been sitting for over 90 days.
The danger zones are defined by future supply. Over 20,000 units are slated for completion in the next 18 months. In areas where new launches are priced only 10% above resale, the resale market loses its competitive edge. If your property is 10 to 15 years old in these clusters, you are competing against modern facilities and fresh leases. This is where equity begins to erode.
Price is what you ask, liquidity is what you get. We are tracking the days on market metric. In cooling zones, this has jumped from 45 days to 110 days. When liquidity dries up, the exit strategy becomes a fire sale. To avoid this, we must analyze the absorption rate of the most recent launches in your immediate vicinity. If the take-up rate is below 50%, the market is saturated.
Should you cash out your current equity? Calculate your net realized gain after CPF accrued interest. Many homeowners sitting on paper gains forget that the longer they hold, the higher the CPF refund required upon sale. If your property's appreciation rate is lower than the 2.5% CPF interest rate, you are effectively losing money every month you hold for a higher price. The upcoming public housing exercises are a game changer. With the introduction of Prime and Plus models, the government is anchoring prices in high-value areas. This creates a psychological price floor for buyers, but also introduces a 10-year minimum occupation period. This lock-in period will drastically reduce the future supply of young resale flats, fundamentally altering the 2030 market landscape.
The optimal exit window is usually 6 months before a major supply cluster hits the top phase. Buyers are currently looking for move-in ready options to avoid high construction interest rates. By selling now, you capture the premium for immediacy. If you wait for the upcoming launches to finish, you'll be competing with hundreds of identical units hitting the rental and resale market simultaneously.
We are entering the era of structural reclassification. The distinction between standard, plus, and prime properties will dictate appreciation curves for the next decade. Standard flats in fringe areas may see slower growth, while plus and prime units will have higher capital preservation but lower liquidity due to the 10-year MOP and subsidy clawbacks. This is the new property hierarchy. Data suggests that the middle-tier property is the most vulnerable. Investors are moving toward two extremes: high-yield compact units or trophy legacy assets. For the average investor, the next decade is about defensive real estate. This means prioritizing locations with transport nodes and educational hubs that historically resist downturns by 15% better than speculative clusters. The real estate market of the next decade won't reward passive holding. It will reward strategic exits and precise entries. Analyze your portfolio not by what it was worth last year, but by its liquidity in the next 3. If the data shows a supply glut in your area, the time to execute your exit strategy isn't next year, it's now. Stay data-driven, and we'll see you in the next deep dive.